So here we got the 2-year SPY daily candle chart, obviously tracking the SP 500. I want to do a fresh analysis video. The last one I did, we were still waiting to see if we could break this 418 level and set a higher high, in which we did. Tested this 200 SMA, sold off quickly, and here we are near the 50 SMA. So what marked this bottom was the last FOMC meeting. Powell came out, flipped dovish out of nowhere, acted as though they have to look at economic data before they continue to hike rates after those minuscule consecutive 0.75% rate hikes. And the top was marked by his last Jackson Hole meeting, where he was a little more hawkish, saying that they're going to continue to fight inflation with rate hikes. So pretty much a completely Federal Reserve controlled move here. And so here's the big thing. Let's look at the M2, updated August 23rd, 22. There's not any decrease in the M2. So inflation's not gone down. It hasn't gone down one bit. Prices have gone down somewhat. Of course, they've cooled down after consecutive years of over 10% of real inflation. We know they're understating it. So that's the first thing off the bat. We got to understand inflation is the expansion of the money supply. In this whole modern monetary theory, in which they think they say inflation and monetary aggregates are not correlated. And what they're trying to do is they can create as much money as they want to keep prices flat, and they'll say there's no inflation. Think about how twisted this is. So they could say this could just go up indefinitely. And if housing and the stock market stays the same and consumer prices stay the same, they say there's no inflation. What they're doing is they're completely neglecting the downside if they didn't constantly inflate. We as consumers would benefit from the downside. We'd get, if you already were in these assets, no, it wouldn't benefit you. But as new buyers and people that are entering maybe the housing market, the stocking market, they get to benefit from these dips, as well as people that were able to time the market. But we don't have a market anymore. They will devalue the dollar and your savings as much as it takes to just keep prices the same. They claim deflation is the biggest concern, but that is only for people that are over leveraged. But the problem is they are over leveraged. So this is what we really need to talk about. Just look about just back in September when Janet Yellen was warning about how a U.S. default on debt will trigger interest rate rise and a recession. So back in September, we were at the debt ceiling. Everyone was panicking. Of course, they raised it for like the 70th time, the debt ceiling. But that's how close we are to defaulting as a country. And as we continue to do more deficit spending and build this deficit and this national debt, the less we can raise interest rates. So here's a good chart that shows this. Under this $5.5 trillion of debt, every 0.5% they raise higher, the actual government has to pay an extra nearly $1 trillion of interest costs. So while they're trying to fight inflation, they're actually going to default themselves. So they cannot actually raise rates more than 5, 6, 7% without defaulting themselves. And that's the corner they're trapped in that they cannot publicly state. But people that are financially literate and the rich know. And that's why they're loading debt like never before on top of the real negative interest rates. So they know not only was all this inflation caused by the central banks, the Federal Reserve on purpose, with intention, now they're just pretending to fight it. They're not actually trying to fight it with 0.75% interest rates hikes. If they were, they had to do it more, but they can't because they defaulted on their own debt. It's not under their self-interest to cause their own interest costs to go up, trying to fight inflation, that they need to keep this economy and debt-based model to keep going. So we're in a real deep Ponzi here. And I think it's really important to note, March 20, under this whole pandemic COVID scare, they lowered the 10% for the reserve requirement on banks to 0%, and it's still 0%. So we have a fractional reserve banking system with 0% required reserve. Meaning the banks don't have to have any money that you have. If you have $1 million at the bank, they used to have $100,000 in there. Now they have to have 0. So think about how that affects their ability to give out loans. Just infinite money getting created on the private banking system, on top of the deficit spending from the government and the stimulus they're doing. The never before seen stimulus. I think in 2008 what they learned was everyone got mad. They occupied Wall Street because they printed all this money. They bailed out the big guys. This time they said, wow, we'll just cut them some checks. We'll cut them some $1,200 checks and we'll keep Main Street quiet. And it worked. They cut them some unemployment checks. They cut them some stimulus. And then they bailed out Wall Street 10 times bigger and no one even noticed. It's nuts. So my whole point I'm trying to drive through is the feds are lying. They're just pretending to fight interest rates. Rising interest rates with the federal government in a perpetual deficit. Where will the Treasury find money to make extra interest payments? New taxes, lower spending, fat chance. In all likelihood, it will borrow to pay interest. So they're going to, check out this, they're going to raise interest rates, which causes them to pay more interest costs, which they don't have, and they're going to have to borrow more money to do it. Just inflation on inflation on inflation on inflation. But they've redefined inflation to just being the rise in consumer prices instead of the actual expansion of the money supply, which it is. And now it's funny because we've seen them in live time trying to redefine what a recession is after 50 years of it being 2 consecutive downward GDP numbers. So, it's just another thing they did a long time ago. They redefined inflation. Now they got everyone thinking it's the rise in consumer prices. So we can print all this money in the world and just send it to China and other countries for goods. And we've even pulled that off for a long time. And we've snuck all that inflation into financial assets and hid it as appreciation. And here we are. It's finally going into goods and they can't hide it no more. And now everyone, it seems, knows about it. Whether you're an 18-year-old new trader or you've watched this shit show since 2008, since they pretty much raped the system, and now in 2020 they've pretty much murdered it. So we got the feds. I think this is probably the smartest Fed I've seen, and they actually came out today on August 31st. Fed's message sees bench rate above 4% and no cuts at least through 2023. And what she said, which I like, she says, so currently Powell called 2.5% around neutral rate of the Fed fund rate. She sees it going over 4%. And most importantly, she said real rates. The difference between the Fed's fund rates and inflation would need to move into a positive territory. So this is the one hope is I think there's so much leverage and margin in these markets right now that they don't have to put inflation nearly as high as Volcker did. All they got to do is put them into positive territory. So that's the hard part. If they put those Fed fund rates around 4%, they got to get inflation down to 3-4%, which is going to be hard. But at the same time, after it's been compounding at this double-digit numbers per year, even if it slows down 3 or 4%, that's off of a much higher nominal number. So it's still confusing. We need actually deflation as for consumers, but that would actually absolutely destroy the market. So, and the whole credit system. So when we look at this Volcker, we could see really what happened. I've talked about this before, but look, Volcker had to put the Fed fund rates up to nearly 20%. But after 2008, they lowered it for so long, nearly 0%. Now they're acting as low 2.5% is neutral. It's just complete horseshit. But over this 5, 6, 7%, the government starts defaulting on their own debts unless they borrow more money, which is more inflationary, which is going to cause more money in the supply. So they're really stuck in the trap. I think what they're going to do is they're just going to posture. They're going to act like they're going to keep hiking. They're going to keep hiking. Maybe they'll take them to around 3 or 4%. They'll actually lie and understate inflation down to that 3 or 4% and pretend like that's close enough to 2%. And then just try to distract us with, crises or whatever kind of type of fear-mongering. But more importantly, I don't think this market can bounce. I think we're headed down to this. We'll go over this overall 340 level, in the next 6 months or a year, because we need every time they print money, they had to do it exponentially bigger. So from compared to 2008 to 2020, they printed so much more, and now they're going to have to print so much more. But they just printed around $10 trillion. How are they going to get away with what kind of pandemic or scare or crisis going to give them the reason to print, 20, 30 trillion, quadrillion, What scares me, it's going to be they're going to milk the global warming, which is just a kind of a unmeasurable problem that they could put. As one person said, I thought was funny, say they could hump global warming forever and create as much money as they want over it to keep the market up under the disguise they're fighting global warming. That's not saying it's not true or anything, of course not, or not being political about it, but I'm saying is they could use a perfect excuse or a reason to just create endless amounts of money in order to inflate these financial markets alive and prop this system under the disguise of helping the environment. So let's go over the actual 5-year chart, because this is where I really think we're headed, this overall trend that it was in from 2017 all the way to 2019. We pushed really hard into before that COVID thing, which you could think is kind of interesting. Look, we pushed pretty hard right before COVID. I wonder if people knew. We know the repo market did crash in 2019 September. That was probably the headwinds of all this. So the overall uptrend would push us now around 340, and with time probably goes to 350, which will be equivalent to where we were before COVID, the all-time highs pre-COVID. And you can see we have formed a little pattern. We've hit the top of here 3 times, and we got this downtrend. So this kind of little pattern right here, we might bounce. I think in the next downtrend one would push us to this overall uptrend, but we will have some supports along this 340 area, right here, this 358, 360 area, as well as where we bounced off before around 365. The 52-week low on SPY is 362.17, so around 3,600 on the SP 500. But let's look at the closer action on the daily. I think I got it on the 200. So the overall uptrend that we formed back in July would push us right back to around 385, which correlates to this support right here, around 385. Above that, we got 388 and then 392. So currently we're at around this 395 support. I think these next ones underneath this will be 392, 388, and 385. Before we head down, we test this 375 and then 370 level. And then underneath that, we're down to that 362.17, 52-week low. And more importantly, let's look at the top 3 holdings and look at their support levels underneath them. So I got this Apple, the 100-day daily candle chart. So underneath our current level, I think 156 the next support. Then I go 151, top of this, as well as the top of this resistance and support on these 2 candles, as well as the bottom of this wick. So 156, 151 to probably the 150 psychological level. It's close enough. And then underneath that 151 to 150 level, it's going to go straight to 145. We see support on this action, as well as here, a little bit over here. So, and under 145, I got 142. Just a little bit of resistance here, bottom of this wick, bottom of this candle. And under 142, on Apple, we got 137.50, which is this one right here. You can see that clear support here and resistance on the top of these 2 wicks. So let's go over those real quick. 156, 151 to 150, 145, 142, and then 137.50. And then underneath that, it's going to be the 52-week low of 129.04, which I think it tests next. That will drive Amazon, that SPY down, the SP 500. So besides Apple, the other top holding, Microsoft. And so the way I see Microsoft's currently around this 261 support, which is also along this overall uptrend it had formed. If it breaks underneath that, I think 256 is next, then 250, and then 245. this action. And let's go to Amazon last. So it's currently right near this 126 potential support, because it was previously resistance here, and here, as well as now being near the 50 SMA. I think that will be the next support level. If that breaks, there will be somewhere around 120 right here. Previous resistance on this action and support on these candles. So 126, 120, and then we got 116, which is also the overall uptrend that it formed here, as well as the resistance of all this action. So under 120, 116, and then 107, which is right here, the support of all this action. And underneath that, we got the 52-week low at 101.26. I think it tests that if it gets under 107. So I think those are the moves that are going to overall drive the SPY back down to, test this 384, 375, 370, and then overall the 370, the 362 52-week low. And then overall, I think we're going to go down, test this overall trend around 340, and maybe even lower, test this action down here to 326, 325. So my overall target's still around like 350 to 330, I'll say. It's like a 5% range, but that's what I'm looking for. I can't be too exact.